Welcome to Real Estate Radio Power Investing, an informative and engaging hour discussing everything you need to know about the world of real estate investing. Your host, Tom K. Wilson, provides you with insight and guidance from his years of experience as a successful real estate entrepreneur on how to buy, sell, finance, and invest in real estate, and much more. Now, here's your host for Real Estate Radio Power Investing, Tom K. Wilson.
Thanks so much for being with us again, for tuning in to our Real Estate Power Investing program, where we empower you with the education to maximize your investing success. We're broadcasting from the #1 business radio station in the San Francisco Bay Area, KDOW AM 1220, the Wall Street Business Network. I'm Tom K. Wilson, your host for this weekly program on real estate investing. If you can't make the live show, you can catch our podcast on TomWilsonProperties.com or on iTunes or on YouTube. Today we have with us real estate timing expert Bruce Norris. We'll bring him on here in just a moment. So you can go to TomWilsonProperties.com and sign up for our newsletter. Gives you a lot of real estate investor education and information. Also gives you access to products that are, many of which are only available to our client base if you're signed up with us. Number of reports, white papers in there. Always welcome your questions and suggestions for future topics and guests to have on. So we're very pleased to have back our periodic guest and good friend Bruce Norris, who is known as in California especially, and getting more notable around the country as a real estate timing expert, because he's studied it. He's a self-made economist, and He's studied it and learned it because he got burned one time and he wanted to know how to never get burned again. And by golly, I love him because he saved me $1 million by getting out before the crash. Bruce, welcome back to the program.
Tom, thanks so much for having me.
Always nice to have you on. Bruce, let's talk a few minutes first about Fannie Mae and our visit back there in December, and what our takeaways were from that and what Fannie's doing. So back in December, actually, Bruce and I started a conversation along with Sean O'Toole and Howard Blum back about, I guess it's almost 10 years ago now, Bruce, believe it or not.
Yes.
And about, the investors are getting really beat up in the crash. They're being made to look like it was all their fault. And maybe some of the speculators did contribute to the problem, but us long-term folks are ones that help remove some of these toxic assets, and yet you're making it really tough on us because it is making it look like we were created the house of cards, and it's not the case. So we got a champion, the chief economist of Fannie Mae, Dr. Doug Duncan, and we got a champion who believed in that investors were a potential solution and not the cause, and started a conversation back in Fannie Mae. And of course, it's a huge ship. In fact, even to this day, they are doing, they're still responsible for 60% of all the loans in the United States. So that's pretty big and influential. And we've got conversations going about how Fannie might make loans easier for the investor. So Bruce and I have been back a couple of times, and they listened, but nothing happened. And now this last time in December, we went and presented to about 60 people, including a lot of VPs and high-level folks. And Bruce, what do you think what was your take on their receptiveness to us and their thoughts?
You know, I really felt there was a significant difference in this meeting. The very first one 10 years ago, it seemed like kind of perfunctory in a way. I think they had their mind made up and how they were going to deal with a lot of the inventory wasn't going to be to expand the financing to the smaller investor, but to maybe deal with maybe partnerships with the big hedge funds and that type of thing. This last meeting, I got a very good sense that they were trying to figure out how to make it happen. And I realized there's some hoops that they have to, go through because of just the acceptance of, okay, let's aggressively lend to investors where there's still that thought in the back of your mind, wait a minute, these are the guys that contributed to the problem. But because Doug Duncan has really been in our corner, I think he's really helped them understand that we were much more of an asset, and there was a speculative group that really isn't a participant at this point. And if they can get more financing to investors, it makes a lot of sense as a business model, especially if they're going to go from being government-owned to private-owned. I think that's the one thing that probably will have to occur before any change happens. But I think if that does, then I think investors will be one of their big customers, and I think they'll make that change.
Talk, if you will, a little bit about specific things that they discussed with us that they could do to make money a little easier for investors.
Well, one of the things that which I really liked about the meeting is they had us there because we had experience dealing with investors. So I've been involved in the loan side, and they were trying to create programs that they thought were going to be safe or maybe make them safer. And one of them would have been, let's say, cross-collateralization of a block of property. So we may consider lending to somebody, but we're going to cross-collateralize. Let's say if we decided the number was 25 or whatever, we would cover all of the properties with one loan. And one of the things I mentioned to them is that being in the hard money loan business, the things that you think would maybe make a decision safer for your loan business actually doesn't allow you to lend to the best people. So there were a couple of things that they talked about where they were going to try and make a restriction in place that they thought that would make it safer, and it actually would make it less so.
And I got that really had not occurred to them. That was a paradigm shift for them.
Right, and it kind of makes sense. It wouldn't have occurred to them, and that's why our participation was important, because we have some street experience saying, okay, I know that sounds good, personal guarantee or whatever you want to do, but you're going to lend to the wrong person. The person that's really strong will not sign on the dotted line for what you're suggesting. So you've really taken your loan program and cut it by 80% and guaranteed you're going to loan instead of to the best group, to the second best group. And I really thought they listened. I thought that was kind of important. Remember when we started and we were getting up there and talking, I wanted to make sure, and I'm sure you did too, that they had time to go into their separate meetings. I really thought that was the best part of this experience, was they went back in teams and came out with really good, well thought out questions. And because we've had experience, I think we were able to really do a direct hit for our industry, saying, you know what, you don't have to restrict the loans in the way you think. We're going to treat you fine. And being a hard money lender and being able to show a track record of performance was kind of important, where they realize, okay, this is your client and this is how they pay us, and it's equal or better to your A-paper programs for owner occupants. And I know that they weren't thinking that probably was true.
Quality of their questions after our initial presentation, the quality of their questions they came back with was very quite impressive, and they were very engaged.
Yeah, that was what was different. The first time I felt like,
we were just pitching. Yeah,
we were pitching. It felt like the reception was, it really was perfunctory. That's the only word I can come up with. But this time, I really felt like that they were really out. And part of what you have to think of is how to come up with a program that's acceptable. That's the politics of what has to go on, is how do you come up with a program that gets a yes answer.
We even had the CEO sitting in the front asking questions. It was they were clearly quite interested, and it was a nice balance there because of your recent experience with doing trust deeds. You could kind of give them the street version of your experience with loaning, even though you also have a lot of experience as an investor. And I was there speaking primarily from the investors' viewpoint of actually buying and properties, and so it was thought we gave them real nice balance, and of course Doug knew that, and that's why he positioned it that way, and it's it was clear to me these are brilliant people, very, very smart people, and with virtually zero street experience, right? They've never been in the real world out there. They're looking at it from an academic standpoint, but they were very open to input.
Well, that was one of the reasons I asked the question. I don't know if you remember, I asked how many of you guys own home houses, and to see if they did have a little bit of some benefit of owning a property, and they could see why owning more of them would make sense. Right.
So let's talk about a couple of things that concepts that came away with. One, we recommended raising the number of loans from 10 to 20 or 25, and they seemed quite receptive to that idea.
They did, and big deal. There's a lot of investors that have that many properties, and the problem with their financing, it's definitely a ticking clock on a reset, or it's all due and payable, or it's got a big prepay. So those loans are not as safe as, say, just give me a fixed loan for 30 years, I'll pay it off. So that dynamic would change people's aggression, too, on not only maybe refining what they already have, so it's a good business model for Fannie Mae, but it would encourage people to say, okay, well, I can comfortably get more of these properties in my portfolio.
All right. And then the other thing we recommended strongly was finance the same as you do as a multifam. Make sure that the rent or the income covers the PITI with whatever debt service coverage ratios you want to, and so they were very, very receptive to that idea.
Yeah, see, that's the interesting thing is we're creating a hybrid product that they already do really well at both a smaller and a bigger level.
Yes. Yep. No. And as you well pointed out, if you'd had this plan in place, we would have not probably had a crash, because you would have had investors lined up wanting to buy this kind of product.
You definitely would have had a lot of smaller investors with money.
Yep. Okay. All right. So we got Bruce Norris on here this morning that we're about to bring back in, and we're going to talk about how we figure out what's going to happen in the future. So Bruce is our California real estate timing expert. We're talking about being our visit back to Fannie Mae. Stay with us. We'll be back for more on real estate power investing.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
Bruce Norris with us today, real estate timing expert, and we're talking about our visit back to Fannie Mae and how they are now more open to making money a little bit easier for investors and maybe creating some new programs. Just before the break there, we were talking about the irony of they've had very successful programs for multifam where loans are based upon the product's ability to pay the debt service, but they haven't seemed to think about that much for houses, but they seem to now.
Yeah, I think we finally made some inroads. It's been really important to have somebody that they trust kind of transfer that trust to us in Doug Duncan.
Mm-hmm. Yep, indeed. Yeah, he's certainly played a major role there. So Bruce, let's go talk about where we are in the real estate market. As I love to share with people that fortunately you and I met in about 2005 when you were starting to tell people that you thought we were going to crash. And having been around investing since the early 70s and watching cycles, I had in my gut a feeling that we were creating a bubble. Didn't understand the numbers, but I saw that we had a dot-com crash, and in the past I'd seen when employment went down and therefore people's income went down, the real estate was continuing to go up. And I just did not understand that the subsidized interest rates were so powerful that they were mitigating and overshadowing the other natural cycles. So when I met Bruce, he put the data behind my gut feeling, and I bailed from most of my California properties and saved me and I'm sure thousands of others millions of dollars. And unfortunately, there were a lot of probably many more people who heard you but didn't do anything, like builders, right?
Yeah, that's the hardest thing. When you're a builder, you're getting an immediate customer response that everything is wonderful and everything is great, and then all of a sudden it isn't. And that's scary to be a builder without a really solid way to look at a chart and say, okay, well this is great today, but it's going to be lousy very soon, so I'm going to make decisions based on that. It's very hard to do, and it's hard to do for anybody, because if you're in the middle of making money and let's say every 6 months you look at your net worth and you own all this stuff and you just made another few $100,000, that's pretty heady stuff, and you pat yourself on the back and say, I'm really good at this. And it's hard to unplug from that and say it's time to cash in. That's not an easy thing to do.
No. About 2 months ago, Bruce had a wonderful class he titled 2% mortgage rates, 40 trillion in debt, and other surprise endings. And even without that flashy title, 450 folks would have shown up, including many that flew in from around the country, to hear what Bruce had to say, because he's past three knees. He's called just right. So we've learned to listen and admire what Bruce has to say, because he really studies it objectively. I remember I know one of the conclusions talking about the builders not wanting to hear it. You've some of the things that you suggested as takeaways is to avoid the emotional pull of the current momentum. Don't need. And
that's true in both directions, by the way.
Sure. Oh yeah.
You get paralyzed in 2009 and have everybody telling you, "Oh my gosh, this is just going to keep on going down," and you stop looking at the numbers and say, "Well, eventually you just go, well, wait a minute, it's something that was $360 that's now $60 that rents for $1,400. Shouldn't that work?"
Yep. So we want to talk a little bit about where things are now. You've called it well before. We only got about half a minute here on this segment, but we'll continue. Have we peaked out yet?
No. There's probably a couple areas if you're in San Francisco where I would be concerned, but if I was in Sacramento and most of the rest of California, I feel pretty comfortable that we have room to go, and that we'll probably get there gradually. Okay.
And we'll get, when we get back in the next segment, I want to talk about demographics and its contribution. What's the book that you've been very impressed with and author about demographics?
John Burns wrote a great book, Big Shifts Ahead. And, it's one of those books that any investor should read.
Okay.
He's only written a winner of a book.
All right. When we bring Bruce back here in a moment, we'll talk about demographics and its impact, how things are maybe a little different now than they were before on Real Estate Radio Power Investing.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
Bruce Norris with us, real estate timing expert. So, Bruce, how are demographics going to help us predict where things are going? So we were at 69.5% homeowner occupancy at the peak of the credit bubble, and we're now down to 63 something. And you think it could go down some more, right?
Yeah, I think it could head below 60%. I have to admit I didn't invent that concept. John Burns did have that in his book. He said it's about 60, and I look at the math and I say, okay, people in my age range and above have a pretty high percentage of ownership, 75, 80%. And when we're no longer here, we're being replaced by a group that's less than that. And each group going down the food chain is less of a participant of ownership. So it just makes sense that you're going to end up with a lower and lower percentage unless there's some boost in the front end that makes ownership seem much more exciting, much more accessible. But the demographics are that you're going to have people, passing away that are 75 to 80% owners being replaced by a group that's less of a percentage. So you're just going to have people be renters more often. So that necessitates financing, but it also doesn't bode well for that particular household. There's a very big discrepancy between the net worth of a renter and an owner at the age 65 and above.
Mm-hmm. Okay. And we have with millennials two things going on, right? One is less people are owning because they want to be more mobile. They saw what their parents went through, et cetera. And also they're creating households later on. So it's a shift in time as well as a smaller percentage. Is that your conclusion?
Yeah, it's a very different way to look at growing up. When I was growing up, the assumption was you were going to be married by 20 or something close to that and start a family and own a house. And now you add a decade onto that 20, and you still may not even be there. So the group of young people are more interested in freedom and being able to move, go to school and a career and so forth. Eventually, I think they'll end up getting married and doing all the things other generations did, but I don't know that anybody expected them to put it off for as long as they have.
And our systems these days, our economic systems, are so complex that even a small percentage shift in something that was predicted before can have a major impact. And here we've got a group of potential home buyers that have shifted out like a decade, right? It's amazing.
Yeah, that's if you're a builder, you're probably just scratching your head.
Yeah,
wow.
Trying to figure out what the heck to do. I know. Let's talk a little bit about affordability index. That's been, a very important metric that you've tracked and taught us about in the past, where we've certainly shown in California that when you hit 17% historically, we've tended to drop in real estate prices, and it this time went down to 12. Just give a little intro on that, and then we'll continue after the break.
Well, what's most interesting about the affordability is it's counterintuitive. You think, okay, as affordability goes down and less people can technically afford to get qualified, volume of sales almost always goes up, and prices continue to go up until we hit that magic number 17. So very intelligent people completely disagree with my conclusions on affordability. And I do find that very interesting and sometimes confounding because of the result afterwards.
Okay, let's continue that right after the break here with Bruce Norris on real estate timing and talking about affordability index. Stay with us.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
So, Bruce, in the past, your trigger point has been about 17%, but now you think that number, the methodology is still correct, but that number might be different. Is that true?
Yes. When I look back at 1980, 89, 2005, 17% was a number that we reached. Then we got, and you had mentioned, got down to 12% because of the crazy financing was in place. So we paid a really dear price for that. And so the whole industry is a little bit more conservative. So getting back to 17% affordability is going to be a challenge in this cycle, because we're going to have lenders are just, even if they wanted to, their hands are going to be they're going to be tied to programs that are more traditional and less aggressive. And then you have buyers that are probably more conservative. They just realize that debt can hurt them. And there's just a different feeling this time. What's amazing, that one of the charts that I didn't put in the report that I should have, and you always do that, you always go, I should have had that one, is the lack of equity withdrawal. That was a big deal between 2000 and 2005.
Yes. Yep.
Hundreds of billions of dollars being extracted to do whatever, usually buy another house. And this cycle, virtually none. So people that have equity actually still have equity.
Mm-hmm. Okay. Yeah, and that's quite a variable around the world too, isn't it? That changes how cycles in different areas work. So you think we haven't reached a peak, except for maybe some overheated high-end areas, but we of course will have a recession again at some point. Is that in the near future, you think?
I think it's in 2018. So I don't know that we'll have it this year, but I think in 2018 we probably will. I just spoke this morning before talking with you, and that was a question, why will we have one? And I think that might come from outside of California, maybe even outside of our country. There's going to be some disruption in the Eurozone and in China, and I think it'll cascade its way into the United States. We don't have a tremendous GDP growth as it is, and we have full employment. And we're due for a recession. We have almost 8 years of growth, and that usually historically is the end of a cycle. And we have a recession, and there's repetitive things that happen while we're in a recession.
Do you think we'll have a softer landing this time?
Yeah, much. I don't think this will be a giant recession, but I think one of the things a recession does is it usually tries to get assisted by low interest rates. So you have a Fed fund rate that generally goes down by 4 percentage points, and we're obviously not even over 1 at this point. So it could be very interesting to see if we actually go into negative interest rates, where the mortgage rate would be. And even if we're only there for 6 to 9 months, that could be a 30-year difference to a lot of people, because they get to refi in a 30-year loan or a 15-year loan. That could have a really big impact on how much spendable income you have going forward.
Mm-hmm. Okay. And, as our friend Doug says, he's talking about outside influence. He's quite worried about Japan, and that could be another one that could impact us.
Yeah, that's the thing. Somebody like Doug Duncan has an economic background where some of the concepts that they comprehend, I don't follow easily, to be quite honest with you.
Mm-hmm. Okay.
And so that's the part where when I'm writing a report and all that, I try to stay with chapters I feel like I actually have a big grasp on. Mm-hmm. I was going to write a chapter on China, and I realized I really have no right to do that because I can't even comprehend how it's working, how they build ghost cities and so forth. So some of that stuff that I think is over my head, I just realized, and like Japan has confounded some really very smart people who have bet against the outcome of Japan's aggressive negative budget, as far as their debt to GDP and so forth is mm-hmm. very high. Mm-hmm. They certainly figured something major would happen, and it hasn't. So some of those pieces I can't figure out. I'll have to let somebody else write a report on that.
Well, you also, I love that you always approach things very objectively, and you try very hard to not have a pre-bias, which allows you, I think, to paint a nicer, a more objective picture. A lot of folks, economists included, I think it's very hard for them to not start to draw some conclusions, and they look for things to reinforce it, and we can all do that.
I think it helps that I have a high school diploma and not a PhD in economics.
Yes, absolutely. And let's face it, one of the most educated and most influential people in the country in the world of economics, Dr. Doug Duncan, obviously has high respect for your input. He invites you to come back and talk. So it's that's always quite respectable, and I think you and I appreciate that Doug is trying to be objective as well by bringing in street input, for example, and to balance with the academics.
Yeah, it's been a real pleasure getting to know him and getting to go back there.
Indeed, and as soon as you guys met, you invited him on our first trip back there. You invited him to come out to I Survived, and bless his pea picking heart, he comes out every year. I think except for one, he had to send one of his deputies there, and he says out of the 87 events he did last year, that I Survived is one of his favorites. So, by the way, put in a plug for that. I've now I think 7-8 year support of I Survived, and if you haven't attended, you owe it to yourself to go down to Bruce's charity event with real estate professional investors and national speakers. It's a wonderful event, Bruce.
I appreciate that very much.
Yeah. So we when we come back here after this segment, we're going to talk a little bit about some of the what should you do about with this information. And very interesting, you've thrown out some pretty interesting wild cards. You never can tell what black swan might change your thoughts, like oil and China and Italy and the euro and those kinds of things. But what do we do with all this information? Stay with us. Bruce Norris, real estate timing expert, is with us today on Real Estate Radio Power Investing. Stay with us.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
Our good friend Bruce Norris with us today, and we've talked a lot about the different metrics that impact the economy, and let's do just a few kind of rapid fire instances. So first of all, Bruce, you still think real estate's a good place to hold assets?
I do. 100% of my assets are connected to real estate, whether it be a trust deed or ownership of a rental or a flip.
And most financial advisors would say you're nuts, right?
Yeah, I like to have my stuff in baskets I understand.
Yes, understand and well-grounded, right?
Yeah, and things I know how to solve.
I think the word real has a important meaning. It's tangible, tangible asset. So do you think long-term holds are still okay as long as they cash flow?
Yeah, I'm excited about that prospect because I do think that we'll have a bigger percentage of people renting going forward, so we'll have demand for our product. And we've got a great interest rate environment, so it's very positive. And
do you kind of think that the federal banks, both here and other places, especially here, are going to do whatever it takes to keep those rates affordable, right?
I would think that that's just part of what demographics will force. So I do think we'll have reasonable rates, but I don't. I think we'll have a peak at something below 3 for a while, but I don't know that we're going to get into a crazy interest rate anytime soon. So I think we have a really good environment for safe rates.
So maybe one of those things to keep in mind is if we do drop below 3, like you think and Doug Duncan thinks, that for us investors it might be a good opportunity to go lock up some long-term fixed rate loans when it has that next dip.
Yeah, if that's the thing. If their decision to do that could coincide with some amazing rates, that would be a lot of fun.
Yep. Fix and flip still okay? Just don't count on markets going up?
Yeah, we did $5 million of loans this month, for people that are doing that, and we virtually have no defaults. So I can tell you, from the loan perspective, business, that's doing very well. We are spec building probably half a dozen houses right now as well in California, so I feel pretty comfortable that we're in good place.
All right, so new construction's okay too. We'll have a recession probably coming up sometime in the near future, but it won't be so drastic that if you get in and out without too many months, the project, you'll probably be okay.
Yeah, I don't even worry. Honestly, I don't think real estate's going to be a big participant in the recession. Mm-hmm. Honestly, we might even be one of those little pieces that get a benefit of it because of an interest rate.
Okay. Bruce, thank you for being with us. Go to thenorrisgroup.com, correct, Bruce? Isn't that right?
Yes.
For a lot of education information, trust deeds, and events that are coming up. Bruce speaks around the state periodically, and also the I Survived event next year. Bruce is probably my favorite economist without a economics academic background, because he's always looked at it very objectively. Also, go to TomWilsonProperties.com for signing up for a newsletter. Also, to get yourself on the list so you can get access to special syndications for commercial multifamily properties for $50,000 a share, and we still have turnkey properties available. So thanks for being with us today. And remember, the only thing that matters is what you do next. Thank you, Bruce, for being with us.
Thank you, Tom.